Who are you guys stealing market share from?
Well, we talked about our value proposition that's resonating with consumers. And when you think about the challenge of the traditional chain full-service dining model to deliver a compelling value proposition in the post-pandemic, post-high inflationary environment, or you think about traditional fast food below us that's had significant price increases at a faster rate than us. From the end of 19 to the end of 2023, we raised price about 12% during that time period. CPI grew about 18%. The Department of Labor has noted that fast food has raised prices upwards of 30%. So that's magnified our relative value proposition. So what we're seeing is folks trading down from full service, trading up from traditional fast food, and even trading over from legacy fast casual players.
So it sounds like you're taking share from everyone.
Yeah, exactly.
We're gaining market share, and I think our unique differentiated Mediterranean cuisine is another way we're resonating with guests, that unique cuisine where taste and health unite. You know, the modern consumer, they want flavorful, satisfying food, but they want their health too. And that's where our food comes in, and they don't have to make those compromises.
You've also added grilled steak to the menu, which you say has significantly outperformed your expectations. Does grilled steak mean more male diners? Because I know Sweetgreen added grilled steak, and part of that was to get more men through the doors.
Yeah, traditionally we've been about 50-50 male-female from a gender mix. And so we've also been 46% of our occasions at dinner. We cook with fire, we roast, we grill, we braise. So grilled steak is a natural fit for our menu. And what we're seeing is it's resonating with all of our customers. It's bringing in new customers, and it's resonating with existing customers who are coming back more frequently.
And where do you see the most growth in either income or age right now?
We're seeing it across the board. We noted this on our call. We're seeing strong comps across all income segments, across restaurants in all areas of the country. So really broad-based strength across the brand.
And you're expanding your footprint as well. I understand you're now adding 54 to 57 restaurants. That's up from 50 to 54. What specifically is driving this faster pace? Is it the hybrid work trend? Is it expectations of lower rates? I mean, something macro like that? Or is this something more specific in terms of where you're currently located?
Well, our goal is to grow to 1,000 restaurants by 2032. That's about a 15% plus compound annual unit growth rate. But our development team and our real estate team have done an exceptional job this year, really building a robust pipeline and able to open restaurants on time and in some cases ahead of time. So that's allowed us to exceed that projected growth rate for the current quarter.
But based on the fact that you're kind of stealing market share from everybody, is it strategic where you put a store? Like, do you want to be close to traditional fast food? Do you want to be close to a traditional competitor? Do you want to be close to fine dining? Like, how do you look at it?
We want to be where our guests want our food, and what we're finding is that's a lot of places, whether it's in the city, whether it's in the suburbs, whether it's in small towns, whether it's in Back Bay in Boston or Bryant Park here in New York, or Fayetteville in North Carolina, or Fayetteville in Arkansas. And I think that's what gets us excited, the broad appeal of our cuisine. It works and meets the needs of so many diverse consumers in so many different parts of the country.
Broad appeal of your cuisine, yet do you make adjustments for local preferences, for a restaurant in, say, New York versus, say, in Texas?
We see pretty consistent menu mix across the country. Certainly a little bit more beef consumption in Texas and a little bit more plant-based out in California, but it's really fairly consistent in all of our restaurants across the country.
Going to something you guys talked about on the call in terms of the same-store sales, and for this year, you're still looking for that to rise about 9.5%. Some analysts talked about that as being conservative. What would you need to see to upgrade that forecast?
Well, we feel really good about the momentum and strength of the business today, and it does imply low double-digit comps for the remainder of the year. What we also wanted to incorporate in those projections was the macroeconomic uncertainty that we're seeing across many industries today, as well as the upcoming election uncertainty in November.
But does that mean that if you get clarity on you're going to upgrade your sales if you get clarity on the election? Like, what's the tie-in? Well, just knowing the uncertainty, people tend to peel back sometimes on spending until they know what the future is truly going to look like.
Well, when people peel back from spending, generally, if you're a retailer, for instance, you adjust your inventory to account for that because you don't want to overorder and end up with too many things that you then have to mark down to move product. What does that inventory management look like at restaurants? Is Cava streamlining and managing inventory in a different way?
Well, for us, we're fortunate that we're delivering fresh food, so that's pretty real-time inventory as we're harvesting fresh crops and bringing that through the supply chain, so we don't see really any impact on that end.
How do you manage all the inflationary impulses?
Well, I think that's been a strength of our brand and the power of our unit economic model. If you think about it, year over year, we've increased wages 9%, investing in our team. We like to invest in our team, invest in our guests. That creates long-term shareholder value. We've also tried to mitigate price increases, invest in our guests. We talked about only that 12% price increase from 2019 to 23. Another example, in California, we did not take any incremental price. I believe we were the only limited service chain that did not take incremental price as a result of the legislation AB 1228 that required wage increases in the state of California. So we don't see those price increases, only about 3% across the chain that we took in January. And that's really delivered a compelling value proposition to our guests. And then at the same time, we've grown restaurant level margin. So that's been the power of the model. As we've driven sales, we've driven traffic, we've gotten that flow through, and it allows us to then reinvest in the business and reinvest in our guests.
What kind of loyalty programs do you have to make sure that you hold on to these new customers that you've taken from your competitors and from lower price chains and the fine dining restaurants?
Well, that's something we're excited about. We talked on the earnings call. We've had the same loyalty program for over a decade. We're very excited to finally be able to relaunch that program in October. And it's what we call an earn and bank points model, where you'll be able to bank up points and then redeem those points for a variety of reward redemptions, a catalog of options for different menu items like your favorite craveable pita chips. You can redeem those points for.
I'm looking at it right now, 100%. Real quick, hiring? Are you doing any of that? Where do you feel the labor market is for you?
Yes, we are hiring. We're, as we talked about, we're opening 54 to 57 new restaurants. That's 54 to 57 new general managers, new team members in every one of those restaurants. We do have a great internal promotion rate. Last year, we placed 75% of our new GMs internally. And then I would note also that our turnover rate year over year is down 28%. So not only are we hiring folks, we're able to retain them and develop them and hopefully promote them into those new general manager roles to open our restaurants.